Session is going to focus a little bit on M&A. Ed, up you come. Yep. Yeah. We've entitled it Bigger, Better, More Alignment. I mean, shipping companies these days, they have a little bit of, values are high. Regulation is tough to navigate. They're not quite sure how to grow. One possibility is M&A, and we've seen a fair bit of it. And so we're going to talk about that. We have Doug Mavrinac, who's Global Head of Maritime Investment Banking at Jefferies, and we have Kosmatos, who's co-CFO of Tsakos Energy Navigation, and they're going to be interviewed by Ed Horton, partner of the Capital Markets Group of Seward and Kissel. So Ed, please.
Thanks, Kevin.
Thank you.
Is this working? Okay. All right. Well, Kevin, thanks, and Doug and Harris, thanks for joining this interview panel, I guess. So as Kevin said, we have seen some recent activity in the M&A space. It's sort of been across the board. We've seen the large company sort of M&A transactions like the Eagle Star deal, put the Frontline Euronav deal into that, although it obviously didn't go as planned. It did result in a fleet consolidation at the end. And then we've seen some smaller company acquisitions, Grindrod and Navigate. And we've also seen some M&A transaction that sort of has more characteristics of fleet consolidations. And Harris, I know you've had one sort of a fleet acquisition from Viking. We've seen the recently announced one from Pangaea for the MT Maritime fleet, and there's been some others in the private side. Maybe just starting out, sort of a general question. If you look at these transactions, and Doug, I'll start with you. If you look at all of these transactions, sort of what do you see as the primary driver, or is there one primary driver for the recent activity?
Ted, thank you for the question. Is this working? Can you guys hear this one? Let me try this. Does this one work? Yeah, perfect. So Ted, M&A has been a long-standing topic of conversation. I mean, I've been, working in this industry for 20-something years, and it was a topic of conversation 20-something years ago. Is bigger better? Do you need to grow, et cetera? And going from 20-plus years ago to 2 weeks ago, sitting in offices talking to CEOs, CFOs about, hey, why is our NAV so low? We've done everything we were supposed to do. We've bought back our stock. We've paid down debt. We've issued dividends. We've issued special dividends, and we're still trading below NAV. So therefore, do I need to grow more? Should I, is something magical about a $5 billion market cap? Does it open up my share price to new investors? So these are conversations 2 weeks ago, 1 week ago, et cetera. It should be the motivation behind why people are pursuing M&A targets, but I'll tell you, the one common theme that I see is, with as simple as it sounds, you have to have a willing seller. Oftentimes companies don't want to cede control, which makes it a bit hard. That's why if you look in the corporate space, you noted a couple of corporate M&A transactions, but there's not a lot. I mean, if you look at, the ones I can talk about, so we're October. This year we've closed 4 M&A transactions. Of those 4, one was, it's in the public markets, V Group for Advent. They had owned it for a number of years. They were a willing seller. It was time to sell the asset. Another was OMP, the finance vehicle. It had been owned by High Tech for a number of years. It was time to sell it. Graham, MSC, was interested in getting into the car carrier business. They offered a very attractive number. You had willing sellers. I'm talking like shareholders, et cetera. Another U.S.-based business. So the common theme there is you have to have a willing seller, and sometimes that's not easy. Activity has been picked up, closed 4. We're going to close another in the next week or so. We got 2 more that are in the market right now. So it's a busy M&A time period, but as you heard, there's not a lot of regular way stuff happening, and once again, you have to have that willing seller.
And I think it's very, excuse me, I think it's very important. Can you hear me? Yep. Okay. I think it's not only a willing seller, it needs to be a sensible seller as well, and a realistic seller, because sometimes if the potential seller sees himself as the prey, they will always go and ask for a premium, which effectively will make the deal totally uneconomical and unrealistic for somebody to pursue. So as long as there is the willingness to be open and receive, the approach by the other company, and you're there to be fair and, of course, make a profit out of it, then yes, it could make sense for you to let the asset or the company go, as long as you are into this kind of mind frame. If not, then it becomes hostile, and as we have seen in the recent past, particularly with the Euronav Frontline, but in other occasions as well, hostile deals hardly work in shipping. There are too many dominant owners, too many dominant management teams that would not let go of the company or the asset unless somebody is willing to overpay for it. And usually, unless you really want to pay the price to get into a certain field, a certain sector, then it most likely it will just fall by the wayside. It will just not.
Yeah, and this is an interview, right? It's not like Q&A or whatever. We can just
no,
chat, right?
please feel free.
So, Harris, you brought up a great point, because that was something I was thinking about as I was trying to think about, the answer to Ted's first question, which you sent around at 3 a.m., so you were up late last night. So, but it was like, not only do you need a willing seller, but you can't really force the issue, right? I mean, Eagle was put in play. And that was one that had a successful conclusion, as we know, with Starbulk. Grindrod was put in play. But in often instances, that doesn't always translate into a successful transaction. I mean, we defended Genco against an overture. There's been others in the room that have defended themselves against overture. So hostiles they often do not work. I mean, once again, and so then, yeah, there's a couple of rare instances where you put someone in play and then it does work, but once again, it came back to, the willing seller aspect.
Right. No, a hostile bid will naturally entrench the other party and will make it so uneconomical on all fronts. And don't forget, it's a very time-consuming and demanding exercise to go through it, and it takes a lot of management time and capacity, out of your day-to-day business. And sometimes, you reach the point that it's not worth pursuing that target as long as you don't see them being recipient to your approach, and you have to look elsewhere. And the elsewhere could be, an asset acquisition rather than the company, which in shipping, it could make more sense.
And on that point, Harris, we're talking about the different structures. So, I mean, we're putting these all into the M&A activity, but a lot of the transactions, some of the recent transactions have been more akin to sort of asset acquisitions. From your perspective, and the 5-vessel fleet that you just looked at, I mean, did you look at that more as an M&A transaction or more of just an asset acquisition?
No, primarily as an asset acquisition, which came at the right time for us. Because don't forget, it came at the back of us divesting some of our older, smaller vessels on the product side. We wanted to beef up our crude exposure. And we also we had just taken delivery of 4 new-building dual-fuel LNG vessels. So this fleet that came our way effectively addressed all the issues that we were looking at the time. One was to substitute the vessels that we were selling, both on the product and on the crude side. We were selling some of our older Suezmaxes without effectively missing on or weakening, if you like, the critical mass that the company has. So effectively, we saw this as a substitution transaction. So it wasn't a transformational transaction in that sense. Plus, it enabled us to beef up our dual-fuel LNG exposure and effectively increase that to 6 vessels, making it approximately 10% of the fleet with dual-fuel capabilities. So in that sense, it worked for us. It was a nice size, so we didn't have to resort to alternative means of capital. We could finance that with our own cash reserves and very attractive bank loan terms that we could get. So it wasn't kind of upsetting in the whole structure, and it wasn't going to create any issues with shareholders by potentially issuing equity at the discount that we feel the stock is trading at. At the time, even today, we feel that it's one thing. I mean, we have 12 vessels under in the new building program of the company under construction. It takes a couple of years for this vessel to be delivered. So inorganic growth effectively is much quicker. So you reach your endpoint, your result, much faster. And in this market, in this both time charter and spot market, acquiring modern second-hand tonnage effectively tick the boxes of us taking advantage of the current situation. Whereas obviously, the organic growth through the construction of new vessels effectively delays your development and ability to benefit from current market circumstances.
I mean, it was a beautiful transaction. I mean, you guys accomplished all the goals that you set out to accomplish, but it was bite size. It was just easier. You don't have the social issues of when you do a corporate transaction of how many board seats am I getting, what's my title going to be. All those things, believe it or not, cause more deals to kind of fall away than happen. So that was a fantastic transaction for all the reasons you mentioned.
So on that point, Doug, I mean, so if you can accomplish sort of the idea of fleet growth or expansion through M&A that looks more like an asset acquisition, what's the scenario where sort of the more traditional corporate business combination is going to make more sense? Yeah,
oftentimes when that willing seller is willing because he needs to sell, that's where those generally tend to work out better. As mentioned just a second ago, Harris's transaction was fantastic because, like I said, it's easy, it's bite-sized, none of the social issues. When you do a regular way corporate M&A transaction, it takes a long time. And not only is it how many board seats am I getting, what's my title going to be, it's, hey, we did like our splits in September, it's now November, so let's go back to vessel's value or Clarkson's, whomever, and rerun the numbers. And then you have to have further negotiations and retrades and all this kind of stuff. So it is exceedingly more complicated and difficult, not even getting to whenever you're dealing with sponsors, but just strategic to strategic. You get more bang for your buck, I would say, if you do like International Seaways Diamond S. We mentioned earlier Grenrod Taylor. You get more bang for your buck, but it is a bit more painful, a bit more costly. But that would be the reason why you do it, is you have someone that kind of really has to sell.
Okay. And like you started, I mean, the concept of M&A activity and growth and valuations coming into this. I mean, Harris, you financed, you used all cash for your transactions.
Correct. Bank debt and cash, own cash.
Bank debt, and I think we're probably going to hear in the next panel, and I don't want to step on those toes, in the capital market space, sort of the current valuations have been a real hindrance to raising capital. In the M&A space, we're also seeing some deals that are ships for shares. Are there more opportunities there to use equity, particularly if it's at a valuation that you may not want to use to issue?
I think as long as you have the capability to use your own cash to buy the asset, then you're going to do that as long as you feel that your stock is trading at a huge discount to its fair value. So in that case, we were not we didn't really entertain the idea of using our own cash, our own stock for it. And it all depends who the other party is. If it's a financial player, potentially a private equity infrastructure fund, then yes, perhaps they could have some appetite to take your stock as part of their kind of investment play. If you're looking across a ship owner, a shipping company that are, as Doug said, that they want to sell, they want to get out, then they just want cash. There is no point in them effectively staying in the market by holding your stock. So it's not attractive to them unless you kill the price and give them heavily discounted stock to them. But usually that's not the case. They will, they want to take the money and run. They just want to exit.
Right. And we are seeing some of the so-called NAV to NAV deals, right, which are a little bit interesting. You need to have a buyer that's looking to stay in, but they're also taking stock at less than
Yeah, and whenever you have someone trading at 85% of NAV and someone else trading at 70% of NAV, it's always going to be, well, let's do NAV to NAV, and then you kind of get through any sort of temporary hiccups and variability in the current market environment. However, while NAV to NAV sounds super simple, as I mentioned, not only is there a data issue, but sometimes it's like, yeah, but what does this guy value my scrubbers for? One guy says 2, one guy says 4, multiply it times 50, and all of a sudden it's a big number. So while NAV to NAV sounds super simple, yeah, it's just a mathematical exercise. We'll do NAV to NAV, we'll put the balance sheets together, and then hit F9 to see what the number is. It's not that easy. Like I said, it gets into, well, this guy is doing a PV of, once again, it comes back to the scrubbers more often than not, of this to arrive at that value, and someone else says something else, and then all of a sudden you have a $100 million gap.
And especially if you have vessels under contract, under long-term charters, then obviously you will try to up the valuation as much as you can based on the cash flow visibility that you have and the counterparty that you have on board.
Right.
And that could alter the price and the price expectations of the other party.
Right, so when you have a negative cash flow adjustment or charter adjustment, there's going to be a fight. And
it's not a good conversation to have.
Yeah, exactly.
So it's a valuation. The valuations can be difficult.
Yes.
Valuations and egos. That's where it boils down to egos.
And egos.
Yes.
Okay.
We'll send people emails, like 10 different titles of what your title could be, and sometimes it's none of those 10 are good enough.
Other than CEO, nothing works.
Right.
Those are the important negotiating points that deals can fall and survive on?
Yes.
Okay. One of the things we've seen in the M&A space, and this is probably from the lawyer speaking, but in the market today, a lot of the M&A work is sort of getting public listings, whether they're former SPACs or whether they're using the shell companies. I mean, I don't know if you've been involved, we haven't spoken about a lot of these before, but is that still a viable avenue to get to a public listing, considering that there's been some other companies that have gone out doing IPOs on a relatively small scale?
All right, I'll start. Yeah, we tried to do a de-SPAC last year, and people talk about how expensive it is to just raise public equity, get a deal done, et cetera. Whenever I got involved in the de-SPAC world and I saw how expensive it was insane. And so I could see why people were pushing back on the concept. I mean, you really have to want to go public via a de-SPAC route today in order to have that happen. And there's all sorts of analogies. Our ECM desk talks about like de-SPACing, which I can't say in a public forum, but it's not the most desirable path right now. A shell company, though, could be something that is an avenue worth pursuing. So.
I don't know. I mean, I'm probably more conservative by nature, and if you want to go into a room, use a door. Don't go, don't climb over the window. And if the door is closed, keep knocking, and eventually, as long as you do the right things, that door will open. And I feel that in most cases, even though we have some positive examples of people kind of going through the back door, if you like, and becoming public, but in the majority of cases, this doesn't resonate with the investment community, the investors, particularly in the big, investment centers like in the U.S., New York. They have, it's kind of, it has some suspicious elements around it, and keep growing, keep doing the right things, and hire the right people, and eventually, people will hear your story. And if the markets are there, you could be able to pull the trigger. But if not, there is no point in being public just for the sake of it, without being able to use all the benefits that the public listing is offering you. Particularly, the stock as a currency, plus all the visibility and the transparency that being public entails.
Yeah, and adding on to Harris's thought about kind of going through the front door or the back door. I mean, it was about a year ago when we were working on a de-SPAC, and all the investors loved the idea. They hated the structure. They hated the dilution. They hated every aspect. And it gets back to sometimes things are expensive for a reason. It's kind of the non-natural route to be able to pursue to get that listing, whereas if you went through the front door, it's a more acceptable, more traditional, easier, more efficient way, and that's why it's not as expensive.
Right. Well, I guess we're a little bit off topic, but we've seen that in the SPACs, right? I mean, some of the back door have not been the best way to get there, and it's proven proven to be that maybe they were a little bit early to go
Yeah.
for the companies, yeah. Maybe just, and I know no one likes to make forecasts, but sort of where we are in the market now. Doug, you talk to a lot of people, you're seeing people. I mean, as far as the M&A activity, are these things that are on people's mind for future M&A activity? Are they looking at other?
No, there's ongoing conversations as we speak in every possible category and sector. I mentioned, we had done 4, one's wrapping up. We have 2 more in the market right now. We have 3 more in the pipeline. And some of these are public-to-public conversations. So I would say that even though the pace at which we've seen M&A activity at the first part of this year has accelerated over the last few years, and the last few years weren't paltry. I mean, there was a lot of stuff done. It's almost breakneck pace right now. It looks to be continuing. And like I said, it's across sectors, public to public, sponsor, sell downs, all that sort of stuff. So there should be an increase or continued increase in activity levels.
Yeah, and I feel that if we're to see a slew of M&As coming successfully coming through, the majority of them will be for diversification purposes. So for financial players, private equities, infrastructures, buying into other companies in in unrelated fields. For example, the case being KKR and Ocean Yield and others, or somebody or owners operating in tankers that they want to diversify and buy, I don't know, car carriers or whatever, LNG companies. I do not think that we're going to see many M&As on the synergistic, if I can use that word, front. I don't expect many companies merging with each other that operate in the same field, in the same sector. I mean, again, the frontline Euronav, okay, eventually they ended up buying, the 24 VLs, but again, as an M&A, it didn't work. So I would expect, as the market remains firm and as all the other financial players and upcoming, owners that are looking to diversify from their field of operations, then we're going to see a pickup in interest in that. But other than that, I don't expect, tanker companies or bulk companies buying each other out, or at least merging. Perhaps, one will acquire the other, but I don't see any mergers, M&As in the true sense of the word happening.
And from your perspective, I mean, as far as if you look at this as sort of a growth opportunity, I mean, going forward, is future fleet acquisitions?
Well, you always have to have growth as your back burner, because being a public company of the size that we are and catering to the needs of the big oil majors, you need to have vessels available, modern vessels available in the market to carry the product for many years, for many years to come. It's a very capital-intensive industry. Vessels are live organisms. They age, so you always need to replace them and renew them and add stuff to them and make them kind of attractive. But you always need to be on the radar screen of your clients, and at least in our case, even though we are one of the largest tanker companies in the world with 75 vessels, and we are selling some of our older vessels, we are always on the lookout, and hence that Viking Crew deal that came our way on how to substitute the vessels that are exiting the fleet and responsibly grow the company in order to maintain the cash generating ability, the earnings ability, and of the company that eventually translates to hopefully increased returns for shareholders.
That's like Kevin, give us like 2 minutes. All right.
You have the last word.
All right. Well, I was going to piggyback off of something Harris said again, because as the audience can probably tell, we see kind of the same things and whatnot. And he brought up an excellent point about, we talked at the beginning about consolidation for the purpose and benefit of scale, but there's also a very real appetite for consolidation for the purpose of diversification. And we saw the Navios companies doing it, with some of the spin-outs and roll-ups last year. And if you look at the share price, it's done extraordinarily well from a diversification standpoint. And this one deal that I alluded to that we're going to be closing here the next week or so is going to be a diversification play. So it's not just scale, but diversification does play a meaningful role. It seems like it's going to play an increasingly meaningful role going forward. The synergistic, There's one that we're talking 50-50, but the majority are not synergistic, as Harris mentioned as well. But I like the point on the diversification point, because we've seen it work, and I think you're going to see more of it as well.
Great. All right, well, thank you both. I think we'll end there at Kevin's request, but thank you both.
All right. Thanks, Ted.